There is a switch inside your brain. Right now, it's likely set to renter. When you look at the stock market, you see a list of temporary things. You see numbers you can rent for a day, a week, a month, hoping the price goes up so you can sell your rental to someone else for a small profit. You are a speculator, a trader of tickers, a renter of flashing symbols on a screen, and because of this, you are in a constant state of low-grade anxiety. You check your phone a dozen times a day. You feel a jolt of euphoria when the screen is green, and a knot of dread in your stomach when it's red. This is the path of the 99%. It is a path of high stress, high fees, high taxes, and almost inevitably mediocre returns. But there is another setting for that switch, a setting that changes everything. It's the setting that Warren Buffett, the most successful investor in human history, has used for over 70 years. It is the, quote, owner setting. And the tool he uses to flip that switch, the mental model that serves as the genetic code for his entire philosophy, is a single, devastatingly simple question. It is a question that, once you learn to ask it before every single investment decision, will transform you from a nervous speculator into a calm, confident, long-term business owner. The question is this: is this a business I would be happy to own for the next 10 years if the stock market were to shut down tomorrow morning? This single thought experiment is the final promise of intelligent investing. It is the key that unlocks the door to a different reality, one where you are insulated from the manic-depressive mood swings of the market, where you are aligned with the fundamental forces of wealth creation, and where your financial future is determined not by luck or timing, but by the tangible success of the great enterprises you choose to partner with. Over the course of our journey today, we are going to dismantle this question, piece by piece. We will explore the 5 profound pillars that support it. We will not just talk about theory. We will dive into the real-world stories, the psychological biases, the practical blueprints, and the hard financial numbers that make this single idea the most powerful tool a retail investor can ever possess. This is not another video about hot stock picks or trading strategies. This is a permanent upgrade to your mental software. This is the moment you stop watching stock prices and start building a fortress of enduring wealth. This is the moment you flip the switch from renter to owner, forever. Our first step on this path of transformation requires us to fundamentally alter our perception of what a stock truly is. We must move beyond the ticker symbol and cultivate what can only be described as the owner's mindset. A stock is not a lottery ticket. It is not a digital token that changes value based on headlines or algorithms. It is a legally binding deed. It represents a fractional ownership stake in a living, breathing business. When you buy a share of Coca-Cola, you are not merely betting on a symbol. You become a part owner of thousands of bottling plants, a globally recognized brand, a complex distribution network, and the daily work of tens of thousands of employees. The 10-year test forces this perspective upon you. If the market were to close, the ticker symbol would vanish. The daily price quote would disappear. All of the noise, all of the speculation, all of the things that distract the 99% would be gone. What would be left? Only the business itself, its sales, its profits, its products, its management. Would you be comfortable owning just that, in its purest form, for a decade? To truly understand the power of this mindset, we must travel back in time to 1963, to one of the most formative and daring investments of Warren Buffett's early career. A moment that perfectly illustrates the stark difference between reacting to a stock price and analyzing an underlying business. This foundational anecdote is known as the Great Salad Oil Scandal. It was a crisis that threatened to bring down one of the titans of American finance, American Express. The company at the time was known for 2 powerhouse businesses, its traveler's checks and its credit card franchise, both of which were synonymous with trust and security. But they had a third, more obscure division, a warehousing business. This division would inspect a company's inventory, like barrels of oil or tons of steel, and then issue warehouse receipts against that inventory. Other banks would then lend money to the company, using these American Express stamped receipts as collateral. It was a business built entirely on trust. In a small, grimy corner of Bayonne, New Jersey, a company called Allied Crude Vegetable Oil, run by a man named Tino DeAngelis, was a major client of this warehousing division. DeAngelis was a charismatic fraudster on a colossal scale. His company claimed to have enormous tanks filled with valuable salad oil. He was issued American Express receipts for this oil and used them to borrow over $150 million from dozens of Wall Street banks. The problem was, the tanks weren't full of salad oil. They were mostly full of seawater, with a small layer of oil floating on top for inspectors to see. When the fraud was discovered in November 1963, Allied Crude Vegetable Oil immediately went bankrupt, owing Wall Street a fortune. And because those loans were backed by worthless receipts from American Express, the banks turned to Amex, demanding to be made whole. The market's reaction was instantaneous and brutal. Panic erupted. American Express was seen as potentially liable for the entire $150 million, a sum that could have wiped out the company's entire net worth. Wall Street analysts, financial journalists, and investors all rushed for the exits. The narrative was simple and terrifying. American Express, the bastion of trust, was on the hook for a catastrophic fraud. The stock price was sliced in half, plunging from over $60 a share to $35 in a matter of weeks. The renters, the speculators, saw only the plunging ticker, the terrifying headlines, and the consensus opinion that the company was doomed. They sold in a frenzy, but Warren Buffett, operating from his small partnership office in Omaha, Nebraska, flipped the switch. He asked the question, if the market for American Express stock closed for 10 years, what would I actually own? He wasn't interested in the opinion of panicked sellers. He was interested in the reality of the underlying business. He ignored the stock price and became an owner investigator. His logic was simple. The salad oil scandal was a disaster for the warehousing division. But was that the real business of American Express? He suspected it wasn't. The real business, the engine of wealth creation, was the travelers' checks and the credit cards. The question was, had the scandal damaged the public's trust in those core products? So Buffett did something the Wall Street analysts, with all their sophisticated models, never bothered to do. He left his office and conducted his own on-the-ground due diligence. He went to banks in Omaha and talked to the tellers. He asked them if they were still selling American Express travelers' checks and if customers were still buying them. They all said yes, business was as brisk as ever. He went to restaurants and hotels. He spoke with managers and waiters, asking if they were still seeing customers use the American Express card and travelers' checks. They, too, confirmed that nothing had changed. He even enlisted his friends and partners to do the same in other cities. The data he collected from the real world was unanimous. The consumer behavior that powered the company's profits was completely unaffected by the warehousing scandal. The public correctly saw the scandal as an isolated incident, not a reflection on the integrity of the iconic green card. Buffett concluded that the market was making a classic mistake. It was confusing a temporary one-time and survivable loss in a minor division with a mortal wound to the entire enterprise. He calculated that even in a worst-case scenario, the company's liability would be manageable. More importantly, the immense earning power of its core franchises was intact and growing. The brand, the true source of the company's value, was untarnished. While Wall Street was frantically selling the stock, Buffett was calmly buying the business. He invested $13 million, a staggering 40% of his partnership's entire capital, into American Express stock. It was the single largest investment he had ever made. Over the next few years, the company settled the salad oil claims for a fraction of what the market had feared, and the incredible growth of its card business continued unabated. The stock price soared. Buffett's partnership made a fortune. This story is the perfect embodiment of the owner's mindset. He ignored the ticker. He ignored the panicked narrative. He investigated the actual business as if he were buying the whole company, not just renting a piece of its stock. He was willing to own it for a decade, even if the market never recognized its value, because he knew the underlying enterprise was a money-making machine. The reason this mental model is so effective is that it short-circuits several powerful and destructive psychological principles that govern the behavior of most investors. The primary bias it dismantles is the tendency to view our investments as disposable objects, a mindset amplified by the frictionless world of modern trading apps. But when you ask the 10-year question, you are artificially invoking a powerful cognitive bias known as the endowment effect. The endowment effect, first identified by psychologists Daniel Kahneman, Jack Nietzsche, and Richard Thaler, demonstrates that people ascribe more value to things merely because they own them. In a classic experiment, participants were given a coffee mug and then offered the chance to sell it. The price they demanded to part with the mug was consistently and significantly higher than the price other participants, who were not given a mug, were willing to pay for one. The mere act of ownership created an emotional attachment that inflated its perceived value. The 10-year test hijacks this psychological quirk for your benefit. By forcing you to imagine owning a business through a decade-long market closure, you are mentally endowing yourself with it before you even buy it. You're not just asking, is this a good stock to buy? You're asking, is this a business I want to be a permanent part of my life? A business I want to be married to for the next 10 years? This pre-endowment process completely changes your evaluative criteria. It shifts your focus from the ephemeral, like recent price momentum or a hot analyst rating, to the permanent and profound. You start asking questions an owner would ask. How strong is the brand? Is the management trustworthy and competent? What are the long-term trends affecting this industry? Does the company have a durable competitive advantage that can withstand the test of time? This process overrides the short-term renter mindset and replaces it with the patient, diligent perspective of an owner. Furthermore, it serves as a powerful defense against our brain's love of simple, compelling stories, a bias known as the narrative fallacy. The story of the salad oil scandal was simple and terrifying. Trusted company in fraud, stock will go to zero. It was easy to understand and easy to act on. Buffett's analysis was more complex. Minor division suffers survivable loss while core, high-profit franchises remain completely unharmed. By forcing a 10-year perspective, you give yourself the mental space to look past the seductive, simple narrative of the moment and engage in the deeper, more nuanced analysis of the business's long-term reality. So how can you, the investor looking to achieve financial freedom, translate this powerful theory into a practical, repeatable process? You need an applied mental model, a blueprint you can follow every single time you consider an investment. Let's call it the business owner's due diligence checklist. This is not about complex financial modeling. It is about changing your behavior to align with an owner's perspective. Step 1. Before you do anything else, you must intentionally ignore the stock chart. Close the tab on your browser. Do not look at the 52-week high and low. Do not look at the 1-year performance. The stock price is a distraction. It tells you the market's opinion of the business today, but it tells you nothing about the business itself. An owner is concerned with the value of the asset, not the mood of the crowd. Step 2. Go directly to the company's most recent annual report and read the letter to shareholders from the CEO. This is the owner's manual. Pay close attention to the language. Is the CEO talking like a business owner or a stock promoter? Do they talk candidly about challenges and mistakes, or is it all corporate jargon and hype? Do they lay out a clear, long-term vision for the company, or are they obsessed with hitting the next quarterly earnings estimate? A great CEO, like a great partner, communicates with their owners clearly and honestly. Step 3. Become a customer. This is the Buffett in Omaha step. If it's a consumer-facing company, you must use its products or services. If you're considering investing in Apple, go to an Apple store. What is the experience like? Are the employees helpful? Is the store busy? If you're looking at Starbucks, go buy their coffee for a week. Is it a product you would happily recommend to a friend? This first-hand experience gives you qualitative data. that you will never find in a spreadsheet. It is the texture of the business. Step 4. Analyze the competition from an owner's perspective. Don't just list the competitors. Ask yourself, why would a customer choose my company over the others? And will that reason still be valid in 10 years? What is the unique advantage? Is it a beloved brand, a patent, a network effect, a low-cost production process? This advantage, this moat, is what will protect your investment during the decade the market is closed. Step 5, and this is crucial for sharpening your thinking, is to write what is known as a, quote, pre-mortem. Imagine it is 10 years from now, and this investment has been a complete disaster. Your capital has been wiped out. Now, write the story of exactly what happened. What went wrong? Did a new technology disrupt the industry? Did a competitor steal all their market share? Did management make a series of terrible acquisitions? This exercise forces you to confront the real business risks head-on, moving beyond a simple bull case fantasy and engaging with the investment as a prudent owner would, aware of all the potential pitfalls. Now let's contrast this deliberate, ownership-focused approach with the antithesis, the path walked by the overwhelming majority of market participants. This is the path of the 99%, the world of the day trader's delusion. The individual on this path wakes up and their first action is to grab their phone and open a trading app. Their mood for the day is set by the color of their portfolio. Green is good, red is bad. Their information source is not the annual report. It's the fire hose of financial news television, Twitter feeds, and Reddit forums. They hear a TV analyst mention a breakout in a certain stock, and they feel a surge of FOMO, the fear of missing out. They don't know what the company does, they haven't read a single page of its financial statements, but they see the stock chart going up and to the right, and they feel an irresistible urge to get in on the action. They buy. The next day, the company reports earnings. The report is actually pretty good, the business is growing, but it misses Wall Street's whisper number estimate by a single penny per share. The stock immediately drops 8%. The headline-driven trader feels a pit in their stomach. The story has changed, the magic is gone. They sell, taking a quick loss, telling themselves they dodged a bullet. They have just sold a fractional ownership stake in a perfectly healthy, growing business simply because the collective mood of other renters soured for a few hours. They then immediately start searching for the next hot tip, the next rocket ship emoji, repeating the cycle of high-activity, high-anxiety renting. They are playing a game they cannot win, a game of reacting faster than high-frequency trading algorithms, a game built on the illusion that one can predict the short-term emotional spasms of the crowd. This is the costly mistake the 10-year test is designed to prevent. It is the difference between trading versus investing. The financial consequences of adopting the owner's mindset versus the renter's delusion are not theoretical, they are direct, quantifiable, and massive. The most tangible impact manifests in a metric called portfolio turnover. Turnover measures how often you buy and sell the assets in your portfolio. The day trader, the renter, has an extremely high turnover rate, often well over 100% per year, meaning they replace their entire portfolio every 12 months or less. The true owner, the buy-and-hold investor, has an exceptionally low turnover rate, perhaps 10% or less. This single difference has two devastating financial implications for the renter. The first is transaction costs. While trading commissions may seem low, they act as a constant, grinding friction on your returns, a small tax you pay for your own activity. The second, and far more destructive, is taxes. In the United States, if you sell a stock you've held for less than a year, any profit is considered a short-term capital gain and is taxed at your ordinary income tax rate, which can be as high as 37%. If you hold it for more than a year, it qualifies as a long-term capital gain, taxed at a much more favorable rate of 15 or 20%. The renter is constantly resetting the clock, realizing gains and handing over a huge chunk of their profits to the government year after year. The owner, by holding for a decade, defers those taxes far into the future, allowing the full pre-tax amount of their capital to continue compounding on their behalf. Let's put some numbers to this. Imagine two investors. Both start with $100,000 and both are brilliant stock pickers, earning a 12% annual return on their investments. Investor A is a renter with 100% turnover, selling everything each year and paying a 30% short-term capital gains tax. Investor B is an owner with a 10% turnover, paying long-term taxes on a small portion of their gains. After 20 years, Investor A, the active trader, would have a portfolio worth about $497,000. Not bad. But Investor B, the patient owner, would have a portfolio worth over $859,000. That is a difference of more than $360,000, generated not by being a better stock picker, but simply by behaving like an owner instead of a renter. The owner's mindset doesn't just bring peace of mind, it brings a tangible and massive financial advantage. It is the first and most critical pillar in building lasting wealth. Once we have firmly established the owner's mindset, the 10-year test immediately forces us to confront a second, more tangible question. What kind of business can actually survive, let alone thrive, for a decade if it's cut off from the stock market? A company that constantly needs to raise money by issuing new stock or debt to fund its operations would perish. A company in a hyper-competitive industry with no pricing power would be bled dry. A company with a fragile business model dependent on the latest fad would become obsolete. The 10-year test is an unforgiving filter. It automatically rejects the weak, the fragile, and the speculative, and directs your attention toward businesses with what Buffett calls a, quote, durable competitive advantage. It forces you to search for companies with fortress-like financial characteristics, strong balance sheets, consistent cash generation, and a protective moat that insulates them from the ravages of competition and time. To understand this pillar, we must examine the story of what might be Buffett's favorite business of all time, a small California-based candy company that taught him one of his most important lessons: the difference between a fair business at a wonderful price and a wonderful business at a fair price. In 1972, Warren Buffett and his partner Charlie Munger were presented with an opportunity to buy a company called See's Candies. See's was a beloved, family-owned business that had been making high-quality chocolates and candies since 1921. It was a household name in California, known for its friendly black-and-white stores and its unwavering commitment to quality. The asking price was $30 million. Buffett's initial analysis, based on the quantitative cigar butt investing style he had learned from his mentor Benjamin Graham, told him to walk away. The company had tangible assets, factories, stores, inventory, worth only about $8 million. The asking price included a $22 million premium for intangible assets, things like brand and goodwill. To the younger Buffett, trained to buy businesses for less than their liquidation value, paying such a huge premium for something you couldn't touch or measure felt wrong. It was Charlie Munger who pushed him to see the deeper reality. Munger understood that the most valuable asset See's owned wasn't on the balance sheet at all. It was the space it occupied in the minds of its customers. For decades, See's had built up a reservoir of trust and affection. Giving a box of See's candies as a gift at Christmas or on Valentine's Day had become a cherished tradition for millions of Californians. When a young man went to meet his girlfriend's parents for the first time, he brought a box of See's. This powerful brand loyalty gave the company tremendous pricing power. Every year, after Christmas, See's could raise its prices by a small amount to cover rising costs of sugar and labor, and its customers wouldn't even think of switching to a cheaper brand. The emotional connection was too strong. This meant the business generated a consistent, predictable, and growing stream of cash. Furthermore, the business required almost no new capital to grow. It didn't need to spend billions on research and development. Its factories were simple and long-lasting. It was, in Munger's words, a cash-gushing machine. They ultimately negotiated the price down to $25 million and bought the company. It was a turning point for Buffett. See's Candies was the perfect 10-year test business. If the stock market had closed the day after they bought it, it wouldn't have mattered in the slightest. The company had no debt. It funded its own modest growth from its own profits. Its success depended not on Wall Street financing, but on its ability to continue making delicious chocolates and maintaining its bond with customers. The results were spectacular. In the years since Berkshire Hathaway bought it, See's Candies has generated over $2 billion in pre-tax earnings, all of which could be sent to Omaha to be reinvested in other wonderful businesses. It required only about $40 million in additional capital investment over that entire period. It was, as Buffett later described it, the prototype of a dream business. The story of See's Candies perfectly illuminates the economics of durability. The 10-year test forces you to look for businesses like See's, companies that possess a, quote, fortress balance sheet and a powerful economic moat. These are the businesses that can withstand recessions, competitive attacks, and the simple passage of time without needing a lifeline from the capital markets. The psychological principle at play here is a powerful defense against two of the most common biases that lead investors astray: the availability heuristic and recency bias. The availability heuristic is our mental shortcut of relying on information that comes to mind quickly and easily when making judgments. The companies that are most available to us are the ones constantly in the news: the high-flying tech stocks, the disruptors, the companies with charismatic CEOs and exciting stories. We hear about them every day, so we assume they must be the best investments. Recency bias is our tendency to overweight recent events and extrapolate them into the future. If a particular sector, like cloud computing or electric vehicles, has had a few years of spectacular growth, we unconsciously assume that growth will continue at the same rate forever. These two biases work together to lure investors toward exciting, fast-growing, but often fragile and unprofitable businesses. They make us chase what's hot. The 10-year test is the perfect antidote because it forces you to invert your thinking. Instead of asking, what is new and exciting, you must ask, what is old and durable? Instead of focusing on what will change in the next decade, you must focus on what will change. Will people still be drinking coffee in 10 years? Will they still need to insure their cars? Will they still be buying their favorite brand of soap? This line of questioning directs you away from the speculative and toward the predictable. It makes you value the boring, cash-gushing economics of a See's Candies over the exciting but profitless story of a high-tech startup. It protects you from the siren song of the new thing by grounding your analysis in the timeless principles of business durability. It forces you to appreciate that in the world of long-term investing, boring is often beautiful. To put this into practice, you need a blueprint for dissecting a company's financial statements with the specific goal of assessing its durability. Let's call this the financial moat inspection. It's a 5-point checklist to help you identify businesses with fortress balance sheets. First, you must examine the debt-to-equity ratio. Debt is the single biggest threat to a company's survival in a crisis. A company with a huge pile of debt must make its interest payments no matter what, even if its revenues decline during a recession. A company with little or no debt has immense flexibility. It is the master of its own destiny. As a general rule, for a non-financial company, look for a debt-to-equity ratio below 0.5. The lower, the better. Second, look for a long history of consistent and growing free cash flow. Free cash flow is the cash a business generates after all its expenses and capital expenditures are paid. This is the real profit an owner can take out of the business without harming its operations. Go back 10 years. Has the company generated positive free cash flow every year? Is it on a general upward trend? A business that consistently gushes cash is a business that can survive anything. Third, calculate the return on invested capital, or ROIC. This metric tells you how efficiently a company is using its money to generate profits. A company with a consistently high ROIC, say above 15%, likely has a strong competitive advantage, a moat. It indicates that competitors cannot easily come in and erode its profitability. Fourth, Analyze the gross and net profit margins over the last decade. Are they stable? Or, even better, expanding? This demonstrates pricing power. A company that can maintain or increase its margins over time has a product or service that customers value and are willing to pay for, a key characteristic of a business like See's Candies. Fifth, and finally, look at the level of capital expenditures. Does the business need to constantly spend enormous sums of money on new equipment and technology just to stay in the game, like an airline or a semiconductor manufacturer? Or is it a capital-light business that can grow its earnings without massive reinvestment, like a software company or a strong consumer brand? The less capital a business needs, the more cash is left over for its owners. A company that scores well on these 5 points is a company that is built to last. The antithesis of this approach is a trap that ensnares millions of investors, particularly during bull markets. It is the siren song of chasing growth at any price. This mindset completely ignores durability in favor of a thrilling story and a rapidly rising revenue number. Think back to the dot-com bubble of the late 1990s. Investors poured money into companies like Pets.com or Webvan. These companies had exciting stories about changing the world, and their revenues were growing at astonishing rates. But they had a fatal flaw. They were burning through cash at an apocalyptic rate. They had no profits, negative free cash flow, and business models that required hundreds of millions of dollars in new investment just to stay afloat. They were entirely dependent on the kindness of the stock market to fund their losses. When the market sentiment turned, when the spigot of easy money was shut off, they had no fortress balance sheet to protect them. They collapsed, and their stocks went to zero. The same pattern repeated in 2021 with many of the so-called disruptive innovation stocks. Investors, driven by the availability heuristic and recency bias, bought companies with soaring stock prices but no history of profitability, no durable moat, and a complete reliance on future financing. When interest rates rose and the market's appetite for speculation dried up, these stocks fell 80, 90, or even 95%. The investors who chased growth at any price were wiped out. The 10-year test would have saved them. No rational person would agree to own a business that was losing hundreds of millions of dollars a year if they knew they couldn't sell the stock or get new financing for a decade. The test naturally filters out these financially fragile speculations. The direct financial connection between owning durable businesses and superior portfolio growth is most evident during periods of economic stress. A portfolio filled with fortress-like companies behaves very differently from a portfolio of speculative growth stocks during a recession or a market crash. Let's compare the performance of a hypothetical durable consumer staples company, let's call it Sturdy Soap Company, versus a high-growth, high-debt software company, SpecTech Inc., during a financial crisis like 2008. When the economy enters a recession, people might cut back on luxury vacations or new cars, but they still buy soap. Sturdy Soap's revenues might dip slightly, but its cash flows remain strong and positive. Because it has little debt, it isn't worried about making interest payments. In fact, it might even use its strong financial position to buy back its own stock at depressed prices or acquire a weaker competitor, actions that directly increase long-term value for its owners. SpecTech, on the other hand, faces a catastrophe. Its clients, looking to cut costs, cancel their software subscriptions. Its revenue plummets. It is still burning cash, and now, with its stock price crushed, it can't raise new money from the market. It has a mountain of debt to service. It lays off employees, cuts back on R&D, and enters a death spiral. Its stock falls 90% and may never recover. The owner of Sturdy Soap sees their portfolio value decline temporarily during the crash, but the underlying earning power of their business is intact. The owner of SpecTech suffers a permanent loss of capital. Over a full market cycle, the ability to avoid these catastrophic losses is a more powerful driver of long-term returns than capturing every last bit of upside during a bull market. This is the mathematical secret to beating the S&P 500 over time. It's not about picking the biggest winners, it's about avoiding the big losers. And the 10-year test is the ultimate tool for doing just that. Having established an owner's mindset and a focus on financially durable businesses, we arrive at the third pillar, which deals with the external world, the constant, deafening noise of the market itself. The 10-year test forces us to confront and embrace a profound truth. The short-term future is fundamentally unknowable, and our attempts to predict it are not only futile but financially ruinous. If you accept that you must hold a business for a decade with no ability to sell, you are implicitly accepting that there will be recessions, bear markets, political crises, and periods of intense panic during your holding period. You cannot time them, you cannot predict them, therefore you must ignore them. The test shifts your focus away from the chaotic, unpredictable noise of daily market fluctuations and toward the long-term, predictable signal of the underlying business's growth in earning power. For a masterclass in this principle, we must turn to the darkest days of the 2008 financial crisis, a moment of global panic when Warren Buffett penned an op-ed for the New York Times that became a legendary lesson in long-term conviction. The date was October 16, 2008. The global financial system was in freefall. Lehman Brothers had collapsed a month earlier. The credit markets were frozen. The Dow Jones Industrial Average had been plummeting for weeks, wiping out trillions of dollars in wealth. Fear was palpable. The dominant narrative on Wall Street and in the media was one of impending doom, with many predicting a second Great Depression. The overwhelming instinct of almost every investor, from the smallest retail trader to the largest hedge fund, was to sell everything and flee to the safety of cash. It was in this environment of maximum pessimism that Buffett published his article, titled simply, "Buy American, I Am." The article was a thunderclap of rational optimism in a storm of fear. But what's most instructive is what he did not say. He did not predict that the market had hit a bottom. He did not claim to know what the economy would do in the next month or the next year. In fact, he stated the exact opposite, writing, quote, "I can't predict the short-term movements of the stock market. I haven't the faintest idea as to whether stocks will be higher or lower a month or a year from now." He was explicitly admitting that the future is unknowable. His decision to invest was not based on a short-term forecast. It was based on a simple, long-term conviction rooted in the 10-year test. He knew that if he bought a cross-section of American businesses at the fire sale prices of late 2008 and held them for a decade, the result would be overwhelmingly positive. Why? Because the long-term earning power of those businesses was destined to grow. He wrote, "In the 20th century, the United States endured 2 world wars and other traumatic and expensive military conflicts. The Depression, a dozen or so recessions and financial panics, oil shocks, a flu epidemic, and the resignation of a disgraced president. Yet the Dow rose from 66 to 11,497. His point was clear. Over the long term, the productive capacity of great businesses overcomes the temporary crises that cause so much short-term panic. He was ignoring the deafening noise of fear and focusing on the enduring signal of economic progress. He announced that he was moving his personal cash reserves into U.S. stocks, including investments like his famous preferred stock deal with Goldman Sachs. He was acting on his own advice, demonstrating the courage of his convictions. The market, of course, continued to fall for several more months. Those who followed his advice immediately saw their new investments decline in value. The renters, the short-term thinkers, would have panicked and sold. But for Buffett, the owner, it was irrelevant. He had bought into great American businesses at prices he knew were attractive for a 10-year hold. What happened in the next few months didn't matter. The subsequent decade, of course, proved him spectacularly right, as the U.S. stock market embarked on one of the greatest bull runs in its history. This incredible display of contrarian resolve is powered by a deep understanding of human psychology, specifically 2 biases that cause investors to self-destruct: myopic loss aversion and the narrative fallacy. Myopic loss aversion is a concept from behavioral finance that combines 2 separate ideas. Loss aversion is our well-documented tendency to feel the pain of a loss about twice as strongly as we feel the pleasure of an equivalent gain. Myopia refers to the short-sightedness of our focus. When you combine them, you get a toxic brew. Investors who check their portfolios frequently, myopically, experience the painful sting of small, temporary losses far more often and more acutely than the gentle pleasure of small gains. This constant pain drives them to sell at the worst possible times, just to make the pain stop. The 10-year test is a direct, powerful cure for this condition. By mentally committing to a decade-long hold, you remove the very option of frequent checking. You are forced to zoom out, to adopt a long-term perspective where the day-to-day volatility becomes meaningless noise. You are no longer myopic. The test also shatters the narrative fallacy, a term coined by Nassim Nicholas Taleb. Our brains are wired to create simple, coherent stories to explain complex, often random events. Every day, the financial media provides these narratives. The market went up today because of a positive inflation report, or the market fell because of geopolitical tensions. These stories create a dangerous illusion of understanding. They make us feel like the world is orderly and predictable, and that if we just stay informed, we can forecast the market's next move. But it's a lie. The vast majority of short-term market movements are random noise. The 10-year test forces you to abandon the futile quest for a predictive narrative. You accept that you cannot know what the headlines will be next week or next year. Instead of trying to predict the rain, you focus on building an ark, a portfolio of durable businesses that can weather any storm. You trade the illusion of short-term prediction for the reality of long-term preparation. How can you operationalize this principle and build a system to protect yourself from the noise? You must consciously curate your environment and your habits. You must go on what I call the information diet. This is a practical, applied mental model for filtering signal from noise. The first and most radical step is to delete the stock market and trading apps from your smartphone. This is the single greatest act of commitment you can make to long-term investing. The constant access to real-time price quotes is the primary fuel for myopic loss aversion. By removing it, you eliminate the temptation and break the cycle of obsessive checking. Second, you must schedule your portfolio check-ins. Instead of a chaotic, reactive process, make it a deliberate, infrequent event. Decide that you will review your portfolio once every quarter, or even once every 6 months. Put it on your calendar like a doctor's appointment. This transforms it from an emotional habit into a rational, business-like review. Third, you must change your reading habits. Stop watching the daily horse race of financial news television and stop reading articles about what the market did today. Instead, subscribe to industry trade journals for the businesses you own. If you own shares in a railroad company, read Railway Age. If you own a bank, read American Banker. This shifts your focus from the stock to the business. You will learn about long-term competitive dynamics, regulatory changes, and new technologies, the things that actually matter over a 10-year horizon. Fourth and finally, practice the mental exercise of inversion. Before you make any investment, ask yourself, what new information would actually cause me to sell this business? Not the stock, but the business itself. Would a 20% drop in the stock price cause you to sell? No, that's just noise. What about a new technology that renders its main product obsolete? Yes, that would be a reason. By defining your selling criteria in terms of fundamental business deterioration, you create an incredibly high bar for taking action, making you immune to the daily barrage of meaningless news and price swings. The antithesis to this disciplined noise-canceling approach is the headline-driven trader. This individual lives in a state of perpetual reaction. Their investment philosophy changes with the morning news. One day, the Federal Reserve Chairman makes a hawkish comment, and they immediately sell all their growth stocks. The next week, a positive jobs report is released, and they pile back in. A conflict flares up in some corner of the world, and they sell everything and buy gold. Their portfolio is in a constant state of churn, a reflection of their own emotional volatility. They believe that success in investing is about being informed and reacting quickly. They see Buffett's approach as passive and outdated. What they fail to realize is that they are playing a game rigged against them. The news they are reacting to is already known by everyone. The algorithms and professional traders have already priced it in before they can even log into their brokerage account. Their frantic activity only serves to generate trading costs and taxes, all while being consistently whipsawed by the market's random movements. They are the proverbial sailor trying to navigate a hurricane by adjusting their sails every time the wind changes direction, when the only winning move is to have a sturdy ship and a firm hand on the rudder, pointed toward a distant shore. They are a perfect example of the perils of trading versus investing, and a cautionary tale for anyone seeking to build real, lasting wealth. The direct financial connection between ignoring noise and achieving superior returns is rooted in the concept of behavior modification. The greatest enemy of the retail investor is not a bad market or a corrupt system. It is their own emotionally driven decision-making. The financial services firm Dalbar has conducted a famous long-term study called Quantitative Analysis of Investor Behavior. Year after year, it shows that the average individual investor dramatically underperforms the S&P 500 index. It's not because they pick bad investments. It's because they have bad behavior. They consistently buy high during periods of euphoria and sell low during periods of panic. They let the noise drive them to do the exact opposite of what they should be doing. The 10-year test and the accompanying information diet are a system designed to prevent this self-destructive behavior. By forcing you to ignore the short term, you are protecting yourself from your own worst instincts. You separate the concept of asterisk price volatility from the concept of asterisk business risk. A stock price can be extremely volatile in the short term, bouncing around based on news and mood. But if the underlying business is durable and growing, the risk of a permanent loss of capital over 10 years is very low. The headline-driven trader confuses these two. They see a plunging stock price and mistake that volatility for fundamental business risk, so they sell a wonderful business at a foolishly low price. This single mistake, repeated over a lifetime, is the primary reason why most people fail to achieve their goal of financial freedom through the stock market. Embracing the unknowable future and ignoring the noise is not a passive strategy. It is the most active and powerful step you can take to safeguard your financial well-being. With the first 3 pillars in place, adopting an owner's mindset, focusing on durable businesses, and ignoring market noise, we can now turn to the engine that drives it all forward, the silent, inexorable, and almost magical force of compounding. The 10-year test is not just a psychological trick or a risk management tool. It is a mechanism designed to unleash the full, uninterrupted power of compound growth. When you buy a great business and refuse to sell it, you are not just an owner. You become a partner with 2 of the most powerful allies an investor can have: a talented management team and the mathematics of exponential growth. By simply staying out of the way, you allow the business's retained earnings and the relentless reinvestment of its profits to work for you, creating a snowball of wealth that grows larger and faster over time. The ultimate case study for this principle is not a single stock that Buffett bought, but the very structure of his entire company, Berkshire Hathaway itself. The story of Berkshire Hathaway is the grandest tale of compounding in business history. It began in the mid-1960s when Buffett took control of a failing New England textile mill. The business was terrible. It was in a dying industry, facing relentless foreign competition, and required constant capital investment just to keep its old machinery running. A renter or a speculator would have tried to flip it for a small profit, or simply liquidated it. But Buffett, the owner, saw it differently. The textile business, as bad as it was, generated a small but consistent trickle of cash. Instead of taking that cash out for himself, he began to use it to buy other, better businesses. His first major move was to buy National Indemnity Company, a small insurance firm in Omaha. This was a stroke of genius. Insurance companies collect premiums from customers up front and pay out claims later. This creates a pool of money, known as float, that the insurance company can invest for its own benefit in the meantime. This was the beginning of the Berkshire flywheel. The struggling textile mill generated cash to buy an insurance company. The insurance company generated float, which Buffett, a master capital allocator, then used to buy wonderful durable businesses like See's Candies. See's Candies, in turn, gushed cash that required little reinvestment. That cash was sent back to the parent company in Omaha and combined with the ever-growing insurance float to buy even more great businesses, like the Washington Post, Coca-Cola, and American Express. The key to this entire process was that the capital never left the system. The profits from See's weren't paid out as dividends to shareholders, where they would be taxed and then have to be reinvested. They were kept within the Berkshire corporate structure, a tax-sheltered compounding machine, and immediately redeployed by Buffett into the next attractive opportunity. This internal compounding allowed Berkshire's intrinsic value to grow at a staggering rate for over 50 years. If you had invested $10,000 in Berkshire Hathaway in 1965, your stake today would be worth over $280 million. This is not the result of a single brilliant investment. It is the result of a brilliant system designed for the sole purpose of maximizing long-term, uninterrupted compounding. The 10-year test is a personal version of this system. By refusing to sell, you are creating your own miniature Berkshire Hathaway, allowing your capital to stay invested and work for you without the constant friction of taxes and trading. The primary psychological obstacle to achieving this kind of result is a powerful cognitive bias known as hyperbolic discounting. This is the fancy term for our brain's strong preference for immediate gratification over a larger, delayed reward. We would rather have one cookie right now than 2 cookies in an hour. In investing, this manifests as an almost irresistible urge to lock in a gain. When you buy a stock and it doubles in value, your brain is flooded with a sense of accomplishment. The impulse to sell and realize that profit, to turn the green number on the screen into cold, hard cash in your bank account, is immense. It feels safe. It feels smart. It delivers an immediate reward. Selling provides certainty today, while holding on for another 10 years for a potentially much larger gain feels uncertain and abstract. Hyperbolic discounting is why so many people sell their big winners far too early. They get the small, immediate pleasure of cashing in, but in doing so, they sacrifice the life-changing wealth that comes from letting a truly great business compound for a decade or more. The 10-year test is a pre-commitment device that directly counteracts hyperbolic discounting. By making the decision up front that you are a long-term holder, you reframe the entire psychological equation. The goal is no longer to get a quick reward. The goal is to successfully own the business for a decade. This mental shift makes the temptation to sell for a small gain feel not like a victory, but like a failure to stick to your long-term plan. It helps you override that powerful primitive part of your brain that craves immediate rewards and engages the more patient, rational part that can appreciate the awe-inspiring mathematics of exponential growth. It forces you to trade the small pleasure of one cookie today for the feast that awaits you in the future. To make the power of compounding visceral and tangible, you can use a simple applied mental model I call the compounding calculator exercise. It is a way to prove to yourself with your own numbers the immense cost of interrupting this process. First, pick a stock you own or are thinking of buying. Second, go to a financial data website and find its average annual earnings per share (EPS) growth rate over the last 5 or 10 years. For a stable, growing company, this might be something like 10% per year. Third, open a spreadsheet and project that growth forward. If the company earns $5 per share today, in 10 years at a 10% growth rate, it will be earning about $13 per share. Assuming the price-to-earnings ratio stays the same, your investment will have more than doubled. Now, create a second scenario. In this scenario, you are a, quote, profit taker. You assume the stock goes up 25% every 2 years, at which point you sell it, pay a 20% long-term capital gains tax on your profit, and then reinvest the remaining capital into a new idea that also grows at the same rate. Run the numbers. What you will find will be shocking. At the end of the 10-year period, the final value of the portfolio in the second scenario, the one where you were constantly locking in gains, will be significantly lower than the value in the first do-nothing scenario. The constant friction from taxes acts as a massive anchor on your long-term returns. This simple exercise can be a revelation. It transforms the abstract concept of buy and hold into a concrete mathematical reality, demonstrating that often the most profitable action you can take is no action at all. The antithesis of the compounding mindset is embodied by the investor who constantly repeats the well-worn but deeply flawed mantra, "You can't go broke taking a profit." This is the profit taker. This person is often a savvy business analyst. They find a great company, buy it at a fair price, and watch it appreciate. But the moment the stock has a significant run-up, say 50 or 100%, their discipline breaks. The fear of giving back the gains, driven by hyperbolic discounting, becomes overwhelming. They sell, pat themselves on the back for their brilliant move, and then face a new and often more difficult problem: what to do with the cash. They now have to find a new investment idea that is as good as, or better than, the one they just sold. They have to pay taxes on their gain, meaning their starting capital for the next investment is smaller. They are constantly forced to find new needles in the haystack, all while restarting the compounding clock at a lower level. The world is littered with investors who bought Amazon in the early 2000s, sold it for a nice 10-bagger, and missed out on the subsequent 100-bagger. They mistook the first inning of a 30-year baseball game for the final victory. They sold a winning lottery ticket for a fraction of its ultimate worth because they couldn't resist the urge to cash in a small profit today. They didn't go broke, but they certainly didn't get rich. The most direct financial connection between the 10-year hold and massive wealth creation is taxes. Taxes are the silent killer of investment returns. As we saw in the calculator exercise, the difference between short-term and long-term capital gains rates is significant. But the true, hidden power of the buy and hold strategy is not just achieving a lower tax rate. It is the benefit of tax time deferral. Let's illustrate this with a clear example. Imagine you invest $10,000 in a stock that grows at 15% per year for 30 years. Scenario 1. You are a true owner. You never sell. After 30 years, your initial $10,000 will have grown to $662,118. If you sell then, you will pay a 20% long-term capital gains tax on your profit of $652,118, which is $130,424. Your after-tax amount is $531,694. Now, scenario 2. You are a profit taker. You sell your holding every single year, pay a 30% short-term capital gains tax on the 15% profit, and reinvest the rest. You are still a great stock picker, finding a 15% winner every year. After 30 years of this process, your final after-tax amount would be just $211,819. Look at those numbers. The final result in the do-nothing owner scenario is more than 2.5 times larger. The difference is a staggering $320,000 on a mere $10,000 initial investment. Why? Because in the first scenario, the money that you would have paid in taxes each year remained invested and continued to compound on your behalf. You were effectively receiving an interest-free loan from the government, and the interest on that loan was working for you. This is the simple, brutal, and inescapable math behind why the world's greatest long-term investors are not active traders. They understand that unleashing the full power of compounding is the only reliable path to building generational wealth. We have now reached the fifth and final pillar of our framework, and it is one that ties all the others together. If you have committed to an owner's mindset, to finding durable businesses, to ignoring the market's noise, and to holding for the long term to allow compounding to work its magic, you are faced with one final, critical constraint. You cannot possibly do this with a business you do not fundamentally understand. The 10-year test therefore acts as the ultimate intellectual filter. It forces you to operate strictly within what Buffett calls your circle of competence. You simply cannot have the conviction to hold a company through a brutal bear market or a period of intense media scrutiny if you don't have a deep, intimate understanding of its business model, its competitive advantages, and its long-term prospects. This pillar is about intellectual honesty. It's about having the humility to admit what you don't know and the discipline to stick to what you do. The most famous example of this principle in action was Buffett's steadfast refusal to participate in the dot-com bubble of the late 1990s, a decision for which he was widely mocked and ridiculed at the time. As the 1990s roared to a close, the stock market was gripped by a speculative mania unlike any seen before. The internet was a transformative new technology, and investors were convinced that any company with .com in its name was destined for greatness. Stocks of companies with no profits, and in many cases no revenue, were doubling and tripling in a matter of days. It was a nationwide gold rush. And in the middle of this frenzy sat Warren Buffett, quietly holding on to his shares of Coca-Cola, Gillette, and the Washington Post. He was not buying the hot tech stocks. He wasn't investing in fiber optic networks or new internet portals. The financial media began to turn on him. He was portrayed as a relic, a dinosaur whose folksy value investing principles were obsolete in the new digital age. The cover of Barron's magazine in December 1999 famously featured a picture of him with the headline, "What's wrong, Warren?" The article suggested he had lost his touch, that he was missing out on the greatest wealth creation event in a generation. Buffett's response, delivered with his characteristic humility and clarity, was simple. He admitted he didn't understand these new businesses. He couldn't reliably project what the competitive landscape for internet service providers or e-commerce websites would look like in 10 or 20 years. He couldn't identify which of the hundreds of new companies had a durable competitive advantage, a moat, that would protect them over the long haul. He understood the technology on a superficial level, but he did not understand its long-term business economics. Therefore, these companies were outside his circle of competence. He could, however, predict with a very high degree of certainty that in 10 years, people around the world would still be drinking incredible amounts of Coca-Cola. He understood Coke's brand power, its global distribution network, and its simple, profitable business model. It was squarely inside his circle of competence. Applying the 10-year test, he could not comfortably own a company like Pets.com through a market shutdown because he had no idea what its intrinsic value was. But he would have been perfectly happy to own Coca-Cola. His discipline was a source of mockery in 1999. But when the bubble burst in 2000 and the Nasdaq crashed by over 75%, wiping out trillions in speculative wealth and driving most of the dot-com darlings into bankruptcy, his decision looked like profound wisdom. Sticking to his circle of competence didn't just help him make money, it prevented him from suffering a catastrophic, permanent loss of capital. The psychological forces that Buffett was fighting are incredibly powerful: the Dunning-Kruger effect and the ever-present fear of missing out, FOMO. The Dunning-Kruger effect is a cognitive bias in which people with low ability in a particular domain tend to dramatically overestimate their competence. In investing, this is rampant. After reading a few articles online or watching a few YouTube videos, a novice investor might feel they have a solid grasp on a complex field like biotechnology or semiconductor design. They mistake familiarity with expertise. FOMO is the emotional engine that drives this overconfidence into action. When you see your friends, neighbors, or anonymous people on social media posting about their massive gains in cryptocurrency or some hot tech stock, it triggers a powerful social anxiety. You feel like you are being left behind, that everyone else is getting rich while you are stuck on the sidelines. This combination is lethal. The Dunning-Kruger effect gives you the false confidence to venture into areas you don't understand, and FOMO provides the emotional push to pull the trigger. The 10-year test is the ultimate circuit breaker for this destructive loop. It is very difficult to feel FOMO about an investment you must mentally commit to for a decade. The time horizon is too long. The demand for deep conviction is too high. The test forces you to move beyond the shallow excitement of the story and ask a much harder question. Do I truly, deeply understand the nuts and bolts of this business well enough to be its partner for the next 10 years? This question demands intellectual honesty. It forces a self-assessment that deflates the Dunning-Kruger effect. You are forced to confront the limits of your own knowledge. It is the simple, humble, and profoundly effective way to ensure you are always playing the game on your own terms, on a field where you have a genuine advantage. To make this concept practical, you must engage in a simple but powerful exercise, mapping your circle of competence. First, take out a blank piece of paper and draw a large circle in the middle. Inside this circle, you will write down the industries, business models, or technologies that you understand, with genuine, deep expertise. This expertise usually comes from one of two places: your profession or your passion. If you are a software engineer, you likely have a deep understanding of software as a service, SaaS business models. If you are a doctor, you understand the healthcare system. If you have spent your life as a passionate gamer, you probably understand the economics of video game publishers better than most Wall Street analysts. Be brutally honest with yourself. This is not about what you've read a few articles about. It's about what you know cold. Now, outside the circle, list all the things you don't understand. For most of us, this list will be vast. Mining operations, insurance underwriting, banking regulations, pharmaceutical research. The rule is simple and absolute. You are only allowed to invest in companies whose operations fall squarely inside that circle. For any company you are considering, apply the explain it to a child test. Could you explain to an intelligent 12-year-old, in simple language, exactly how this business makes money and why it will still be a great business in 10 years? If the explanation involves complex jargon or you find yourself stumbling, the company is outside your circle. Put it in the too hard pile and move on. As Charlie Munger says, it's not a disgrace to have a too hard pile. The antithesis of this disciplined approach is the investor who acts as an expert in everything. This is the individual you meet at a cocktail party who has a strong opinion on every topic. They can tell you why oil prices are going up, which biotech stock is going to cure cancer, why Chinese tech stocks are a buy, and what the Federal Reserve is going to do next. Their knowledge is a mile wide and an inch deep. Their portfolio reflects this. It is a chaotic collection of the last 10 hot ideas they heard about. There is no unifying theme, no deep conviction, just a random assortment of story stocks and speculative bets. They are constantly jumping from one thing to the next, always chasing the action. This investor is destined to underperform. They are perpetually playing an away game. When they invest in a biotech company, they are competing against PhDs in molecular biology. When they buy an oil stock, they are competing against geologists and commodities traders who have spent their entire lives in the industry. They have no edge. They are relying on luck. The investor who stays within their circle of competence, however, inverts this dynamic. A software engineer investing in a SaaS company has a genuine analytical advantage. They understand the product, the competitive landscape, and the customer behavior in a way that a generalist investor never could. They are playing a home game, and that is a massive advantage in the quest for long-term portfolio growth. The direct financial connection here is the ultimate form of risk management. The greatest financial risks do not come from market volatility. They come from fundamental business misjudgment. They come from owning a company you don't understand. Imagine two investors own shares in a pharmaceutical company. The company announces that its flagship drug in phase 3 trials has failed to meet its primary endpoint. The stock instantly drops 60%. The first investor is the expert in everything. They bought the stock based on a hot tip. They don't understand the science. All they see is a massive loss. They panic and sell, crystallizing a huge loss. The second investor is a biologist who has worked in pharma for 20 years. This company is inside her circle of competence. She reads the clinical trial data. She understands the science. She may conclude that the market has overreacted, that the company's other pipeline drugs are still incredibly valuable, and that this massive price drop is actually a spectacular buying opportunity. Or she may conclude that the failure truly is catastrophic, and that she should sell what's left. The point is, she can make a rational, informed decision based on her expertise. The first investor can only react with fear based on his ignorance. Over an investing lifetime, the ability to correctly diagnose problems and differentiate between temporary setbacks and terminal decline is a skill that generates enormous wealth. Operating within your circle of competence is what makes this kind of rational, executive decision-making possible. It is the final, crucial pillar that supports the entire structure of the 10-year test, ensuring that your long-term ownership is based not on hope, but on a foundation of genuine understanding. You have just spent this time rewiring the core of your investment philosophy. You've installed a powerful piece of mental software, a system that transforms you from a nervous renter of stocks into a confident owner of businesses. This is the 10-year test. It is a filter that automatically rejects the noise, the hype, and the short-term speculation that derails the 99%. It is a compass that forces you to navigate by the fixed stars of business quality, durability, and compounding, shielding you from the market's violent and unpredictable emotional storms. You now possess the framework that Warren Buffett has used to become the most successful investor in history. But this mental model, as powerful as it is just one critical node in a larger network of thinking. It is a complete system for answering the question of what kind of business to buy. It directs you to find wonderful, durable companies that you can understand. But there is another, equally important question that this model alone does not answer. That question is when to buy. How do you know what price is fair for a wonderful business? Owning a great company is half the battle, but paying too high a price for it can lead to years of mediocre returns. The next step in your journey is to connect the principle of ownership we've just mastered to the critical discipline of valuation. You need a tool to calculate a company's intrinsic value, so you can buy it with what Benjamin Graham called a margin of safety, a discount that provides both a cushion against error and the source of your future profits. The video that is now appearing on your screen is the missing link. It is the bridge between identifying a great enterprise and buying it at a price that almost guarantees a favorable outcome. It takes the what and connects it to the when. It is the next piece of the map, the component that completes the circuit between business analysis and investment action. The average person will stop here, satisfied with this single powerful idea. But you have not watched this far. You have not invested this much of your time to be average. You are on this path to build a complete mental arsenal, to master the entire system of intelligent investing. The decision to click is not about simply watching another video. It is a statement about your commitment to this journey. It is a choice to continue your ascent from amateur speculator to sophisticated capital allocator. Complete the connection. Click. And continue to build your fortress of financial freedom.